So Kevin O'Leary, Mr. Wonderful, welcome back.
Everything reverts to the mean, and so when you see stretching like this going on, you know the outcome is just a matter of around the corner. My argument about this whole thing is, what we don't know about tech yet is this PE expansion, or is this a situation where cash flows are actually growing in these companies? We'll have to wait a couple of quarters to find out. My point is, you don't have to lose your value norms. You can always say that you can buy into 11 or 12% of any mandate, any sector. But to say that you abandon the values of looking at a multiple of cash flow is, that to me is like that old show, Warning Red Leader, that is.
But they're not. They're playing a relative game. They're saying if the market is X, then I can get a little bit more comfortable doing Y. They're not saying throw it out.
There's a way to play the middle. You can go right back into the small tech space, which has continued to perform across all the sectors of the Russell 2000. And that story is we've only just begun. Every time I look at that index, I hear Karen Carpenter singing. We've only just begun.
You can be a value and growth investor within tech. Yeah. Look at these older names,
why be
the Intels, the Ciscos,
the truth is, if you add discretionary,
Microsoft, then you can go to the FANGs, and you got the chip still if you're a value. I mean, there are places, multiple places.
Do you remember
to look and stay true to your ideals?
No, but the point is, if you add Amazon, consumer discretionary, on top of tech, we're past 30%. Last time that happened, grown men wept right after the peak of the internet bubble. I'm not saying that's going to happen here.
PEs were.
I get it, but the point is, anytime a sector becomes so darling to every investor that it takes almost a third of the whole index, is often a time to trim.
Unless, and I hate saying this time it's different because I know the inevitable groan, but
Famous last words, my friend.
Wait a minute, hold on, consider this. There is no signal in PE ratios in tech. Actually, the lower the PE, the worse the stock is done. However, what if we're at 30% of the S&P or thereabouts for tech weighting, because these really are not technology companies. They're just companies, and their tentacles have spread into so many verticals and industries that it's almost impossible to compare them to, back in the day, we had a chip company, a software company.
There's always justification for why it's different this time.
But what is Amazon?
It's not different.
But what is Amazon, first of all, classified by S&P Dow Jones as a consumer discretionary? Second of all, they're in pretty much every business save for medicine, and that's probably coming within a year.
I think there's a lot of consumer discretionary involved in every time somebody goes to the Amazon site and buys something.
But that's my point. It's other sectors.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.